Hi, everybody. Welcome to season 4. That's right, season 4 of No Show. They said we couldn't do it, but we made it, and we're here. New year, new us, and we have an amazing guest today. These days, you can't click on a hotel trade article or a podcast or a clip from a conference panel and not see a quote from Zach Demuth. What's he talking about? He's talking about industry trends, investment insights, destination tourism, asset management, hotel transactions, and a fleet of related topics. Based in New York City, Zach is the global head of hotels research for JLL's Hotels and Hospitality Group. He oversees the global hotel research platform and drives the group's content and data analytics efforts. He sits on the Real Estate Council at Boston University School of Hospitality Administration and is an advisor to the Pillsbury Institute at Cornell University. He's an alumnus of both, world traveler, excellent cook, risk taker, fisherman, and the hardest working man in hotel research. Zach, welcome to No Show.
Thank you guys so much for having me. I don't know if all of that is true, but I appreciate it nonetheless.
So, Zach, listen, the fisherman part, Matt does good sleuthing. I didn't know you were a fisherman, but excellent cook. We're going off script right away.
Oh boy.
What's your go-to? You're entertaining. You're having people come over for the first time. What are you making?
So my wife and I have recently really got into making our own pasta. We got a pasta maker for our wedding a number of years ago, and I think we've recently tried to break it out more and frequently. I'd say my wife is more the creative type, and I'm more on the execution. But I would say we're that good at it yet. But we enjoy our own cooking. Nice bottle of wine and fishing. Yes, I got that from my dad. Still do a lot of it. Less these days than I'd like to, but as much as possible.
Let's get to the meat of it, right? 2024. Man, no pun there, right?
Yeah, no pun intended. Yeah.
2024. We saw a lot of activity, particularly among brands using their balance sheets to drive growth. Why is this remarkable?
Yeah, I mean, I think when we think about the way the hotel brands, and we're talking about Marriott, Hilton, Hyatt, IHG, and if you look to Europe, Accor, the way they make money is by generating fees, right? And the way they increase that on an annual basis is either by what they call same store growth, which you guys know means the growth of existing hotels, right? Existing hotels generate more RevPAR and they generate more fees, and by adding new hotels to their collections. Historically, the latter, so adding new hotels to their collections, is about 50% of their year-on-year fee growth, which drives their shareholder value. And historically, that comes from new organic supply development, right? So the development of new hotels that they ascribe their names to, conversions, right? An independent to a Marriott or a Hilton to a Hyatt or whatever. What we started to see kind of the immediate aftermath of COVID in mid-2020 and 2021 is that there was a material slowdown in new supply growth. Construction got exceptionally expensive, right? We all know about these well-documented supply chain disruptions, which caused not only delays in construction materials, but driving up high costs. And then on the back of that, we've seen the US and other major economic bodies increase interest rates, which means development financing, which is often the riskiest form of financing, became exceptionally challenging, if not impossible. So these confluence of factors, again, they started in mid-2020, 2021, 2022, really came to a head in 2024 and will continue actually for at least the next 3 to 5 years, such that the development of new hotels in the US and globally is much slower than it has been historically. Nearly 220 basis points or 2.2 percentage points less than its long-term average over the next 5 years, which is a significant slowdown. And so again, going back to the brands, the way they derive growth, 50% of their growth by adding new hotels to their collection, in the absence of organic supply growth, really the only way to do that in a material manner is by acquiring other brands. And again, that is exceptionally rare. We saw Marriott do that with Starwood, of course, way back, although that was a bit of a different acquisition, although one could argue similar trajectory. But we saw in 2024, you saw Hyatt acquired Standard, you saw Hilton acquire Graduate, and we'll talk about some of the interesting partnerships such as Marriott, Sonder, and everything else. But I think that's just the tip of the iceberg. We've heard rumors about Hyatt possibly acquiring Playa, which is an all-inclusive platform in Mexico and the Caribbean. A lot of other rumors out there that can't obviously name names, but I think we'll see a lot of that in 2025, probably even more in 2026. And that's just in the US, right? Globally, there's tremendous amount of what we call brand M&A or brand partnerships on the horizon.
what stood out to me, Marriott is kind of a well-oiled machine in this field at this point. You mentioned Starwood, which nobody can forget because it's such a big deal. But by the time it got to Starwood, Marriott had made an acquisition almost annually, right? Buying AC, coming out of the Iberian Peninsula with a little bit of a Latin American presence, but it made Marriott, with that acquisition, the largest supplier in those areas. And then it bought Protea the next year in Africa. Probably not well known to our listeners, but it made Marriott the largest supplier of hotel rooms in Africa. And after that, Delta, it's the largest in Canada. Check that box. Gaylord, largest of big boxes. Check that box, right? Then along comes Star. So by the time it got to Starwood, it felt like it was a well-oiled machine ready for M&A. But really, I think to your point of using the balance sheet, Marriott had a history of doing those things. What was really stood out to me in 24 was two things that you touched on. First, that Hilton did it, right?
Pretty
Hilton,
rare.
not one in the Niceta era,
Yeah.
right? I mean, the thinking there was always, why buy if you can build?
And can you guys just fill in real quick? Why was that rare for Hilton? What do you think stopped them from doing that in the past?
Well, I'll give my take. I think there is a reluctance to spend the money to buy a brand when you have a well-oiled machine to build it, right? Why buy? And Matt, you and I years ago talked about the example with Kimpton. Why spend the 420 million that IHG did to purchase Kimpton when within 10 years you can just create Canopy and have the same distribution? To create a brand probably cost you 20 million. To buy that brand probably cost you 400. Zach, what's your take?
Totally agree. And I think you asked to look at the roots of these companies, right? So obviously Blackstone owned Hilton for a long time. Blackstone is a real estate company. So I think they really understood the real estate, and they recognized that, to Jeff's point, you could either acquire independent hotels or even alternative uses and spend less money to convert into a new hotel brand. You could build ground up, which Blackstone is very familiar with. And so I think, again, that goes to Hilton's roots of again, way back, all the brands were real estate companies, but that goes way, way back. Hilton's not that far back, right? It's pretty recent. And Niceta is still a holdover from that generation, as is Kevin Jacobs and all the others. And so you look at their roots, I think they recognize that they had their competitive differentiation was actually the ability to build new brands from the ground up at a less expensive cost and with a higher growth trajectory than it would be to buy. I mean, I think Spark is a great example of that. What Hilton did with Spark, in my opinion, in that space is groundbreaking. They took old Home2s, old Hamptons, old Comforts, and recognized that it would be cheaper and they could actually get this great arbitrage with owners by offering the conversion to a new brand. Marriott, at first, at least, their response was to acquire City Express. Again, an acquisition, not a build-up. Now, since they've followed up with Studio Res and others. But I think, again, Hilton's, you have to go back to the roots of the company and how historically they've been able to grow at arguably better multiples. They're still a smaller company than Marriott, but their multiple historically has been, up until this year, has traded at higher rates than the other brands.
Let's say you have 300, it's all about NUG. And if there are going to be 300 openings of Hampton, that may in a year only net 150 because 150 are going to exit the system. Right? They're too old. They don't fit the brand. And it's probably too expensive to bring a 30-year-old Hampton up to the modern Hampton brand standards. That's where the brilliance of Spark to me really was the arbitrage that you mentioned is in that example. 150 hotels don't necessarily have to leave the system. And instead of upgrading, a Hampton Inn for 15 million, maybe it only costs $5 million to become a Spark.
Exactly. And you look at what Hilton did acquire this year in Graduate, it's a very different play. I think arguably it's one thing to build from the ground up a mid-scale brand, maybe even upper mid-scale brand. It's an entirely different thing to build from the ground up I'm not saying Graduate is luxury, but a lifestyle type brand. Now, obviously, AJ Capital did it. It took them a long time, and success was kind of all over the map. So I think to build a brand like that from the ground up in today's environment, given everything from a construction perspective and availability of land, is a challenge. It's to acquire it makes a lot more sense, right? So you look at what Hilton has historically built, you look at what the other brands have built. Again, it's much easier to build in the lower segments. It's much harder to do it in the higher segments, and particularly to capture that level of demand. I mean, we see this amazing confluence for a lot of different reasons, demand for lifestyle in both luxury and sort of that upscale space. I think that is a secular trend, but it also may be somewhat short-lived. And so I think Hilton recognized now is the time to do it. We can, monetize fees. It's a relatively low basis, but it's not the same as, acquiring a mid-scale brand, which they think and have proven that they can build from the ground up.
Why do you think it's going to be a short-term trend?
Again, I'm hesitant to say short term. I think it's going to be the next. I don't think it's peaked yet, but I think we're getting there. In some ways, having branded lifestyle is sort of antithetical, right? The whole idea of lifestyle to some capacity is that they are boutique, independent hotels. Now, I think the collection brands, the Autographs of the world, the Luxuries, the Vignettes have done a really good job of saying, hey, you keep your level of independence, but you get our distribution system, and so you can increase your demand. And by and large, the average consumer doesn't necessarily think or know they're staying at a Marriott or a Hilton or a IHG. They see the independence. But sort of the branded lifestyle space, to me, again, that kind of goes against the idea of this authentic experience. And again, I know Graduate's a bit different, right? Because they play on, of course, the university, and they are all unique. But I worry that when you see more and more of these kind of upper upscale, even luxury, but they're branded lifestyle, does that sort of go against the whole idea that consumers want unique and authentic experiences?
Yeah, the other trend, and you touched on this a bit at the top, that I thought was remarkable in that I think it has great staying power, and would love your take on this too, is partnerships. Right, what Marriott did with MGM, what Hilton has done with small luxury hotels. That's new in this space, right? Like, you guys stay yourselves, just get on Honors and get on the Bonvoy platforms, right? Uh, Hyatt's also doing it. I mean, this whole conversation isn't a Hilton and Marriott conversation, but I mean, they're the big boys and they're setting the trend for the future. That's the one that I see has almost unlimited potential.
Totally agree, right? And Hyatt did it with Mr. and Mrs. Smith. You mentioned obviously small luxury hotels, Marriott MGM, Marriott Sonder, which is a totally different beast. But I think it goes back to kind of what we talked about at the top, is that brands generate revenue and drive shareholder value from generating fees. And in some ways, generating a fee through a partnership is actually the lowest risk, because they really don't have to outlay anything. Sure, in some cases, they outlay a little bit of capital. Sure, they dedicate some sales resources, obviously some distribution resources, but they're not managing the properties. They're not taking any ownership for them. And so for them, it's just a pure fee play. And from the perspective of the partnered brand, right, whether it's Mr. or Mrs. Smith or small luxury, obviously you get plugged into this, generally speaking, incredible distribution system. The fees you pay for the booked reservations are generally lower than you would otherwise pay on the third parties, the OTAs. So generally speaking, it's a win-win. And I think we'll see more and more of that. I think what's happening in Vegas, to me, it started with Marriott and MGM. Hyatt just signed a licensing deal with Venetian, which is fascinating because they signed it literally the day that Venetian's agreement with IHG expired. It's pretty incredible, right?
Coincidence, I'm sure.
Yeah, I'm sure, right, exactly. And I think Vegas is a market, obviously tremendous amount of demand, one of the highest occupancy markets in the US and the world, despite having more hotel rooms than any market in the US. And for years, the major brands have kind of been hesitant to build because it's very expensive for obvious reasons. Some challenges or some concerns with the casino environment. But we can do a partnership. We can still generate close to as much fees as if we had our own hotel there, but we don't have to assume any risk. And so I think that's going to be a fascinating game. But these partnership agreements are unique. I mean, the Venetian sort of spelled it out. They're not forever, right? They typically are 20, 30, 40 years, or even less sometimes. And so you create customer confusion, right? One day I'm saying the Venetian under an IHG rewards. Tomorrow it's Bonvoy. I don't know. To me, it's a bit odd, but great for the brands overall.
One day we have Uber and the next day we have Lyft, right? The two big monsters that really, I don't think brands and the hotel industry in the US really talk that much about or focus as much on as they should are Las Vegas, and then the other, in my opinion, is Disney. Do you think is there a partnership? Is there something out there, like, who could tame Disney? And would anyone even try to bring that into a brand partnership?
A really interesting question. Arguably, why not? I think what I found interesting about Vegas and MGM's perspective is, prior to Marriott kind of creating that partnership, MGM, and they're obviously pretty public, were running 85% annualized occupancies. And it wasn't clear to me from their perspective what accretive additions Marriott could add. It's not an occupancy play. Or are they creating a more loyal customer base? Did they add a higher rated customer base? And again, hasn't been long enough to play out. And so, yes, there must be that. But I wonder in Disney's case, I mean, you'd have to, from their perspective, it would have to add enough value. But again, I think never say never. I look at all the partnerships that materialized in the last 2 years, a lot that I know are coming over the next 12 to 18 months. A lot of them I never would have anticipated 10, 15 years ago. I think Disney's interesting, right? You look at what Lowe's is doing in Orlando around a lot of their new Disney resorts. And again, Lowe's is a brand we almost never talk about, very different than the others, still a pure play real estate company in many ways. But is that something, right? I mean, there was this talk in 2019 around Omni and Lowe's possibly forging a partnership, which sort of fizzled for a variety of reasons. Again, two smaller brands, but if that's possible, why couldn't we see one of the big ones get in there and create some sort of a loyalty sharing partnership?
Do you remember that when the Nickelodeon Marriott experiment was attempted, right? How can they get into this Disney game in Orlando? But they needed to find a different partner, something that was also an appeal to kids, and fell flat on its face. Mainly, you can't recreate the entertainment industry from a hotelier's background, and I think that's
Totally.
where Matt and I are fascinated with Las Vegas, but I think that's that similar gap why brands have not been successful on the Strip. They aren't going to be successful in creating theme parks.
I mean, beyond the expense of getting into either market, particularly Vegas, is the culture just so different from what you need to do, what you need to provide, the skill set you need to have to run the hotel? Is Vegas just kind of a one of one?
Yeah, I think in many ways it is. And I think, it's interesting, right? The brands, particularly over the last 5 or 6 years, have tried to find new verticals to expand into, again, to increase their loyalty, to drive higher share of wallet. And I think what you've seen, particularly in 2024, and we'll see over the next 3 to 5 years, is their core competency is running hotels. Doesn't mean that they don't have loyalty sharing agreements outside of the traditional hotel space. You mentioned Vegas, talk about Sonder shortly, obviously their credit card companies, yachts, et cetera. But they typically turn, again, it's either a partnership or a third party to help run it. Because I think there's a recognition, and it's been to your point about the Nickelodeon example, it's been proven out in other places. They're just not built to do that. They also, and it's been very clear based on some of the unfortunate recent restructuring, Wall Street doesn't value that, right? Wall Street values fees. It doesn't value them taking on additional risk via headcounts, via experimental things, right? It's unfortunate in some ways because I think they could do it if given the resources. I mean, they have the resources if given the leeway, but I mean, Wall Street is very quick, right? And for better or worse, these are all public companies for the at least for now, and their value is generating fee revenue.
I think that goes back to the spin of Park from Hilton, right? The core principle there is not that Blackstone still owned the same amount of real estate it did, January 7th as it did January 6th of 2017 when it was Hilton and Park were separated. But by doing that, the investment landscape was very clean.
For sure. Marriott Host, exactly right. I mean, all of the brands have gone through this evolution. It's interesting, right? We talk, obviously, we're in the U.S. We talk heavily about the U.S. brands. My work also covers global, right? And so it's interesting because Accor, which is the largest brand in Europe and actually one of the largest brands in the world, even though we don't talk about them as much, they're in the midst of going through their spinoff from Accor Invest, right? And so they're actually they're in the stage that most of the U.S. brands were in a decade ago. And it's interesting to watch. They're following a similar playbook, but also possibly making it better. But again, valuation, they still get some credit for their real estate holdings, whereas in the U.S., Hyatt's basically sold off all of their holdings in the past two years and will sell off the remaining over the next year. And they get so much credit for that, right? Whereas 10 years ago is a totally different landscape.
Now that 2025 is here, we're seeing a renewed sense of optimism among hotel investors who are bullish about urban markets and luxury assets. And that optimism applies to both domestic and international capital. I think it's easy at the beginning of this year to think that everything literally is on fire on all fronts. What do you think is behind all of this optimism?
Yeah, I mean, I think it's no secret, right? Over the last 2 years, the commercial real estate sector or industry broadly has been very negatively impacted, right? Interest rates not only rose, but rose quicker than really in any other period in U.S. history. Pretty much ground everything to a screeching halt. And this comes off the back of 2021 and 2022 were actually some of the best years for hotel investment volume in the U.S. Cumulatively, around $80 billion were invested into hotels in 2021 and 2022, the best 2-year period we've ever seen. Again, 2023, declined, to less than a quarter of that, and then 2024 declined even further. I think what we're starting to see, right, is on the back of COVID, there was a tremendous amount of pent up travel demand. We know many hotels were posting double digit RevPAR growth, which for those of us in the industry know that that's not normal. There's a lot of reasons for why that happened, but it's not a normal situation. And I think owners were kind of saying, like, why, interest rates are high. I'm not going to get the value I want. Why sell? Because my hotel's performing exceptionally well anyway. And so I'm not going to be able to trade for what I want, but I'm going to be able to get operating returns. Now we're starting to see performance normalize. Interest rates remain high, but they're coming down, and there's clarity that at least they're not going to rise any further. They may not fall as much as people want. And this is what really drives hotel investment volume in the US, urban hotels are finally starting to perform exceptionally well. You see the return of international travel, particularly from Europe, starting to see some inbound from Asia, see the return of groups, some corporate demand. And so investors that have held these hotels are starting to see their performance normalize or moderate. Interest rates are, at least there's clarity around that. And performance, again, there is some green shoots from the segments that historically or that have been slow to rebound. So we're starting to see a lot more interest. Private equity groups who have raised a tremendous amount of money over the 2 years and just haven't been able to invest because interest rates are high, started to come off the sidelines. We saw REITs, which have been hit a bit hard by the public markets, but some of them, like Host and others, have been quite active in the past 12 months and will continue to be. We also see a lot of new capital coming to the hotel space, which this to me is the long-term trend and really exciting. Hotels have, after decades of being an alternative asset class, most funds allocate very little, if any, to the hotel space. Starting to see institutional funds allocating 5, 10, 15% of their real estate holdings to hotels. Last year, we saw 20% of all global hotel capital was acquired by first-time buyers. And so I think this is exciting. It creates a lot of educational opportunities. We all know hotels are complex beings, operational assets, everything else. But I think there's a lot of excitement, a lot of optimism. And, 2025 is not likely going to get back to 2021 and 2022. I don't want to, it's going to grow, but not to that same level. But by 2026, 2027, we see a lot, again, barring any unknowns, a lot of really positive momentum on the horizon.
Yeah, it's hard to talk about 25 or the future in any definition without mentioning AI. And one of the things that really stood out, there was an article in Focus Wire recently that I thought was really good, looking in travel predictions, the kind of thing you get this time of year. But here's what really caught my attention: the question of, will AI-powered search, Copilot and the like, take a significant share away from Google, and will startups flourish or the big get bigger? Anyone looking at AI as the great equalizer might be disappointed, was the quote. And that intuitively fits where I'm seeing, or at least, my perspective looking forward. AI depends on data. The more it has, the better it functions and advises. So it seems to me like the biggest companies with the most data are going to be the first and the largest winners. Do you see it playing out that way? Marriott and Hilton, are they really in that wonderful little position to go value from the technology that's crashing down all around us?
Yeah, it sort of pains me to say this, to be honest, but the hotel industry, and this is well documented, has historically been woefully slow to adopt new technologies. I mean, we all know this, obviously, Jeff, from our days at Marriott. Marriott, to this day, I know they're possibly changing, but still uses a reservation system that was built, in the 80s. And I think the other brands have historically, similar challenges. It's really hard for me to envision that suddenly they're going to go from these antiquated tech companies to riding the wave of the future. Now, there's no reason they shouldn't. They have tremendous data. I mean, beyond the fact that they're fee-generating companies, the reason they acquire all these brands and they have all these partnerships is to drive loyalty. And, cumulatively, they have upwards of 1 billion loyalty members. And there's no reason why, with all this data they collect, they basically force everyone to use the apps. They shouldn't be able to create truly customized trip experiences, trip planning. I mean, there's really no limit. But I have personally a really hard time seeing it, just based on the way they've historically adopted. And again, Wall Street doesn't value them to be tech companies. And so, sure, they might dabble here and there. They might acquire third parties. They might partner. But for them to go out and invest all these resources to become a tech company, which ostensibly is what this would require, it's hard to envision. Now, on the flip side of that, everyone wants to talk about AI from a hotel perspective, from the consumer side, right? The connected trip is sort of this holy grail that Booking.com touts and some others, personalized travel, personalized marketing, all these things. And that would be amazing. to me, the opportunity is, and hotels have used this to some capacity. Obviously, we know with revenue management and others, but it's back of house. It's not as sexy, it's not as intriguing, but it can have a real impact in your operations. Whether, again, revenue management operates on some level of AI, that's great. What about staffing? Again, there are some systems out there. Goes back to collecting the right data, staff optimizations, labor force optimizations, food costs, smart thermostats. I mean, there's a lot of these things that, again, from the consumer's perspective, they don't care. They may never see it, but that can have a material impact on the hotel space, which already struggles with cost challenges and profitability issues. And so to me, that's where the opportunity is. Again, consumers don't want that, and that's not where the headlines are going to be, but I think that can have a real impact on the industry.
Of course, one of the biggest hotel stories of the last 2 years was Taylor Swift's Eras Tour. Maybe you've heard of it. According to JLL, the pop star's world tour generated approximately $1 billion and counting in additional hotel revenue across the US, Europe, and Asia, with its impact rivaling traditional tourism drivers like the Super Bowl and even the Olympics during its peak periods. Quote from JLL in one of the articles, in some ways, she's created many, many, many Super Bowls. Now, Taylor Swift and Beyonce, their impact on local economies has been reported breathlessly by news outlets. My question to you is, what should hotels do with this information going forward? Do they sit around and wait for another mega tour? Or do they start being proactive about partnerships with musical acts of all sizes? How can they take what we've seen over the last couple of years and set themselves up for success?
Yeah, I mean, first, it's pretty astonishing to me. I'm, not necessarily a Swiftie, although sure, the music's on all the time. But, the fact that we write about her effect on the industry and have been over the past, almost 2 years now is just really incredible. I think hotels have to be proactive moving forward. I think, one shift that I see in consumer behavior that is probably secular, or at least will hang around for a good period of time. People are willing to travel for live experiences, whether that's concerts. Obviously, we see it with sporting events. We see it in a number of things. I mean, what's fascinating about Taylor Swift is if you look at the impact in Europe, more Americans actually traveled to Europe to see her event, stayed at a hotel, booked an airline ticket. The impact from Americans there was bigger than from Europeans, right? And there's a variety of reasons for that, the strong dollar and everything else, but people clearly travel for that experience. So I think hotels have to be proactive. I mean, obviously you can't recreate, a mega tour of that nature by yourself. But is there partnerships you can do? Another brand that we often don't talk about, but is becoming somewhat larger is Sinesta. They've created these live music partnerships with either local artists or regional artists. And then they really use that kind of as a jumping off point to manufacture demand. And I think, again, in the absence of organic demand from these events, you have to do something to manufacture it. You have to create a buzz. And I think consumers will travel for it. I think, again, you have to be cautious, right? Simply creating partnerships just for the sake of partnerships, they can be expensive. So you have to figure out, is there a real return? But I think there's shown there's huge opportunity. Consumers will travel for experiences, whatever that experience might look like.
I think to bring this full circle, that's exactly what Disney and Vegas have figured out a long time ago, right?
For sure. Yeah.
How to create demand. Who goes to the middle of the desert? Well, they create a reason for you to go. Hundreds and hundreds of thousands of people every day going to Las Vegas. Or, well, maybe not hundreds and hundreds, but the capacity of Vegas is what, about 150,000 room nights?
50,000. Yeah. Right. And you talk about, similar in some ways on a different scale, but what's happening in KSA and, Saudi Arabia, right? All the mega projects there, they welcomed 100 million visitors this year. In 2019, they welcomed less than 10 million. I mean, that growth is staggering. Now, granted, they've invested hundreds of billions of dollars. Obviously, they basically have, never-ending capital for a variety of different reasons. But I mean, again, going literally to what was the middle of nowhere, and they're welcoming people by the droves, Europeans, Americans, Asians, like all across. And again, that's about manufacturing demand.
It's time for the lightning round. Zach, what's the most overrated statistic in hotel research?
Oh boy, probably an unpopular opinion, but RevPAR. I think RevPAR should die one day. And don't get me wrong, I love my friends at STR, and I think very highly of them and what they've created. And I get why we use RevPAR as an industry, but RevPAR never tells the whole story. It's been the case pre-COVID, but if COVID has taught us anything as a hotel industry, RevPAR should not be used. RevPAR has grown double digits, and in many cases, profit, whether you look at the GOP level or the NOI level, has not. And I think as we move forward, the industry wants to tout RevPAR, RevPAR, RevPAR. And again, if you're the operator, maybe that's great. If you're the brand, maybe that's great. If you're the owner, like that doesn't help me. You can't take RevPAR to the bank. And I won't say too much more about it, as I know the industry loves RevPAR and I don't want to offend anybody, but I think that's the most overused, overrated statistic.
Does the current model of owner operator and third party manager have any fatal flaws in it over the next decade?
I mean, absolutely. And I think it has over the previous decade, right? There's just a lack of alignment. You look at most hotels these days in the US, and they have 3 or 4 constituents that all have different goals. The brands, as we talked about, they're fee generating. Really, all they care about is top line revenue. In most cases, it's just rooms. What if you have other revenue sources? If you're the third party operator, you care about everything and you care about obviously generating profit for your owner, but then you take a fee off of that. And if you're the owner, you take what's left over. And so again, I think maybe RevPAR is part of the reason to blame, but there's a lot of things in there. There's just a lack of alignment. And I think particularly as the brands become less interested in managing and really turn to, again, franchise businesses, you have more third-party operators. It's a very competitive space. We've seen some of the biggest third-party operators really struggle, right? Because they compete on fees and that actually leads to their demise. And so how does that space unfold over the years? And then from an owner perspective, how do you sort through the chaos? And I think it's going to be interesting to see, in the US, we're a very mature industry, generally speaking, but like in Asia right now, the third party management space is basically zero, but the brands don't want to manage. So they have to find somebody to fill the gap. So I think it's going to be really interesting to see the evolution.
What's one piece of unbiased, unvarnished advice you'd give to an investment group looking to buy a select service or luxury hotel?
Know your market. I mean, we love to talk about how the select service segment performs exceptionally well, which it does. We love to talk about how luxury performs well, which it does, but it's all market specific, right? I mean, you gotta know your market in and out. You gotta know what drives demand, what supply looks like today, and what it will look like tomorrow. And if there aren't organic demand drivers, can you manufacture that demand at a reasonable cost? Because if any of those things are out of balance, it doesn't matter if you have the best hotel in the world or the best hotel anywhere. If you don't know your market, if you don't know what drives demand, you're never going to be successful.
Hey, the way Matt asked was select service and luxury. Is full service the monkey in the middle?
I think it is, right? I mean, I think, again, your traditional full service hotel and whatever brand you want to pick relies very heavily on that semi-commoditized consumer, right? The average business traveler or the typical business traveler, typical group customer, right? Less differentiation. Again, not saying that these hotels don't have a place. They absolutely do. But they've been sort of the forgotten children of COVID. Now we're seeing return there and we're seeing a lot of renewed interest, right? As some consumers from the top end get pinched down because of economic reasons and group travel returns. But yeah, I think it would be interesting, right? And that's why liquidity has declined so much. That middle, which historically has made up 70% of investment volume in the US, has all but disappeared over the last 2 years.
What's the most essential piece of clothing you take with you when you travel?
Oh, that's a good question. I don't know. I'm not really a clothes guy. Recently I've been trying to switch from not wearing like traditional dress shoes and go to the sneaker route. I think that's been really helpful. We don't wear ties anymore, so I'm a really big like fun sock guy. So I try to, and I have different. I've been fortunate to travel a lot, and so I buy socks for every city I'm in. Try to wear the socks from that city. New Orleans has some really cool socks with the cable car. Yeah, so I guess for me, that's my like little bit of whimsy. I'm not really a whimsical guy, but that's where I can add a little bit of differentiation in my wardrobe.
So pro socks, anti RevPAR. You heard it here, everybody.
There you go.
Can't think of a better way to start season 4. This is insightful, phenomenal. Thank you, Zach.
Thank you. No, thank you guys so much. Really appreciate the invite and really enjoyed the conversation.